thought I'd report a quick summary of the auditing process as we've just gone through it. This is just so that you can always have something handy to go back to with regards to auditing and how to tackle it. So I'm just going to share my screen, right? And what I'll do, I'll try even make highlights so that you guys can be able to keep up with me, right? I'll start with the other color. See how it works. So essentially, I'm going to highlight, let me see if that works. If I highlight the audit strategy, what happens? Okay. Oh, just works like a normal highlight. Okay, I'll make that pink for no reason except I want to. So in essence, as you may have known, the ultimate objective of an audit is to express an opinion. What does that mean? So people like myself, shareholders, banks, some employees, trade unions, they rely on financial statements for making decisions, for engaging the company. And at the end of the year, when a company has presented its financial statements, somebody needs to vouch for those financial statements. Somebody objective, somebody external needs to come in and say that, in my opinion, these financial statements are free from material misstatement, right? It doesn't say that these financial statements are 100% correct. It just says these financial statements are free from material misstatements, meaning that already the first thing that we get introduced to is the concept of materiality. I just want to see, it's giving me a problem highlighting. Okay, I'm gonna make that green, right? Concluding, reporting, and evaluating. Right? That is in essence what we're aiming to do. We're aiming to get to a position where we can express an opinion on the financial statements so that users of the financial statements can see that somebody has taken a test to ensure that these financial statements don't have misstatements that could change their decisions. And so that is why from the get-go, what you see is that the concept of materiality becomes important, right? So we immediately need to determine a number at which items become important. So I'll give you an example. If you're auditing Microsoft and the revenue is 150 billion for argument's sake, and you decide that $700,000 is your materiality, everything below 700,000 is really not going to affect you. It's like that rounding up that we do when we've got money and we want to spend it. And if something is 89.99, we essentially say whatever, it's 50 rand. And whenever we're receiving money, if we're receiving 89.99, we say we're receiving 100 rand. That sort of thing. So we just want to determine at which point does it not matter if you round up or down, right? So that's the materiality. And every financial transaction or misstatement that is above materiality then communicates to us that the financial misstatements are not free from material misstatement, right? So that's the first thing that I wanted to just touch on. From there, what we look at, we've got essentially two items that are going to stay with us throughout the audit, right? It's the audit strategy and the audit plan. Now I'll start with the audit strategy because that one, it tends to not shift as much throughout the audit. And it essentially gets done at the beginning of the audit. And for audit strategy, the important thing that we're going to be looking at is what's the scope of the audit, then what's the direction of the audit, and then what are the resources that we have available to us. Again, you cannot audit Microsoft, for example, without considering AI. You cannot audit Microsoft without considering experienced team members, that sort of thing. The resources, Microsoft has basically got headquarters or offices all over the world. So you definitely know that if you're auditing Microsoft, you essentially have to be in a position to be able to either travel to all of those locations or to have sufficient resources on the ground to be able to do work for you in those places. And that is, in essence, is called the audit strategy, i.e., in which direction is the audit going to go? What is it going to focus on? So again, if you sit back, the major thing that you'd need to think about with Microsoft is that you'd need tech expertise and you'd need geographical access. That's essentially the scope and direction of the audit. Without those, you essentially know that there isn't much that you can do that will give confidence regarding the audit, right? Then the other items that I'm highlighting that you can see there is the internal controls in computerized environments. In 2023, you just have to accept that everything is computerized. Then you're going to look at assessing risk of material misstatement at financial statement level, and then determining an overall response to financial misstatement level, financial statement level. Again, as I say, because we're dealing with strategy, it's very big picture, it's very overall. So you need to understand the systems that they're running. You need to understand to what extent your tech needs to be on par, right? And then from there, you need to identify then from that overall big picture, organizational picture, what are the chances that the financial statements are misstated? Just solely looking at that overall um, picture. So little things, for example, like management is incentivized to produce increasing revenues or increasing profits, for that matter, to justify their work in AI. Management needs to be able to consider the environment, all of those things. You consider them and you think how much pressure do they have or how much incentive do they have to essentially end up having the financial statements reflect material misstatement, and we're not able to pick it up. And then the overall response, as I said, at a strategy level, the main things that you really ever can do is actually get very qualified, very experienced staff, have regular reviews of the audit, and make sure that you continuously exercising your professional skepticism and you consistently aware, you know, that's the important thing with the audit strategy, and how you will respond to risks at financial statement level. The higher the riskier the audit, the much more experienced the people that you'll need on that particular audit. And all of this information, you'll know it because you'd have done pre-engagement. And pre-engagement, you'd have assessed what are the factors that I'm going to be dealing with when I take on this client. So you'll see there, I've made that pink, right? Then the rest of the document is essentially going to be dealing with what we call audit planning, or what we call at assertion level. Now here, this is where it becomes important to understand that now you're dealing with the numbers themselves on the financial statements. You're actually dealing with every line item, line by line on the financial statements, right? That's audit planning. And the important thing that we're trying to satisfy for ourselves during planning phase is what is the nature of the work that I'm going to do there. And you will see now as we touch on it, it's essentially going to go, it's going to ask ourselves, are we going to do tests of control? Are we going to do substantive testing, or a combination of both? Most often it will be a combination of both. It's very rare that it will be just one or the other. You'll see here that under computerized environments and key controls, I'm essentially highlighting that. The reason I'm highlighting that one is because the moment you have key controls in a computerized environment, and not just the computerized environment itself, there is then a specific outcome that may come out that it will most likely affect the financial statement. So that's why the key control part hits the audit planning, right? Then again, just like with the audit strategy or with the overall consideration, you then are going to do a risk assessment procedures to look what are the chances that line item figures are not correct, or they are not free from material misstatement. And an easy thing to look at is last year, for example. Last year, did they have a challenge auditing debtors? Did they have a challenge auditing revenue? Did they have a challenge auditing management expenses, meals and entertainment, that sort of thing? And you're going to essentially come to an assessment of material misstatement, or at least of the risk of material misstatement at a certain level. And by risk, we mean what is the likelihood that this item can be misstated materially? Again, there I'm having a problem with my highlighting. Right? And so when I touch on this concept of risk, the main thing that's important is that often we mistaken a risk factor to a risk itself. What is a risk factor? A risk factor, you consider for yourself that if the financial statements are misstated, what item or what facts will tell me that now while I'm still doing my planning? That is a risk factor. And then the risk is that that financial statement line item is misstated. So the risk factor is something like invoices are paid before they're received. So the client says it's going to cost $20,000. We pay the $20,000. Then the invoice comes afterwards. That is a risk factor. The risk factor is that invoices are coming after payment has been made. And the risk is that we can end up overpaying or underpaying our suppliers, that sort of thing. Often the response at a certain level will be now what we're looking at, which will be the test of detail or the test of control. That's the response that you often, not even often, that you will perform at that level. So whereas with the financial statement level risks, the only response that we could action out was to get more qualified staff, more money, more resources, that sort of thing. At a surgeon level, at line item level, the response that we can do is we can test the controls that feed into that function. And what does it mean when we say we are testing the control? At this level, we're not testing the numbers themselves. We're testing all the activities that go into producing that number. Again, what do I mean? In order for us to recognize revenue, we need to place an order. After we've placed an order, we need to first get a quotation. After we've received a quotation, we then need to place an order. After we have placed an order, we then get a delivery note and then an invoice. If all of those happen, irrespective of the amount that is on the paper, if all of those things are happening without there being reviews, without there being people that are authorizing the next step of the transaction, I don't even need to audit the financial statements, because then I can already tell that the controls that create those financial statements are not operating well, or they're not appropriately designed. What do I mean by not appropriately designed? Sometimes you find that the function is actually being implemented correctly. There are approvals. However, the method in which the approvals occur is not in such a reliable manner that I can, as the auditor, say that I'm going to base my opinion on it. So the CFO tells you that before a payment is made, the clerk comes into his office normally on Monday morning, and they confirm that, yes, that is indeed the price that we have been quoted. They don't give them an invoice. They don't send them an email. There's no documentary proof that can basically give the auditor comfort that I have seen how you have performed this function. Therefore, we say the design of the control is not correct, or it's not. We wouldn't say it's not effective, but yeah, the design is flawed. It's not there. Then the other one is the implementation of the control. Sometimes you find that the control is there, so we say that the CFO has to sign every purchase requisition before a purchase order can be placed, right? But when we look at the purchase requisitions, they're not signed, but orders have been placed, meaning that the CFO is not implementing the control and the entity is essentially functioning without the control occurring. The risk there again is that you have numbers in the financial statements that may not even have been authorized. And if the CFO knew that those amounts were going to be incurred, he wouldn't have authorized them. And therefore, that amount shouldn't have been spent to begin with. So that's what you're looking at when you're dealing with test of control. Then after test of control, you're dealing with substantive procedures. Remember, we're still under planning and audit planning, and we're still dealing with assertion level items. So we're looking at the risks of material misstatement at assertion level, meaning that the risk that a particular assertion is not met. And we're still dealing with the nature of the testing or the nature of the risk assessment, and we're dealing with test of control or substantive procedures, right? As I said, substantive procedures, there's essentially two. One is analytical procedures. You often will use those if the controls are working correctly. So if all the documents are signed and you're happy with that, then you can start to do analysis. Okay, I expect that since 12 or 52, depending on whether it's monthly or weekly, requisitions have been signed. I therefore expect that at the end, the total amount should approximate XYZ. So let's say the CFO can only sign for transactions up to 100,000, meaning that if there are 52 weeks and they do sign-offs once a week, roughly you're looking at about 5.2 million. It's 5.2 million. No, 1.2 million. Well, if we're looking at 52 weeks, it's 5.2 million. And if we're looking at 12 months, so if the function is done monthly, then you're looking at 1.2 million. There now, because we're dealing with numbers, we're starting to look at substantive procedures. And in this case, it's just an analytical procedure. We're just looking for reasonability. Given that XYZ happened, we expect profit before tax to be 19%, 20%, whatever you. So then we often quantify it in percentages, right? Those are the analytical procedures. Then from there, we go to, so often if the control is working correct and you perform analytical procedures and they give you the number that you want that is in the financial statements, you sometimes can get enough assurance on that. On the other hand, you have a situation where the controls are not working effectively, or we do our analytical procedures and they don't give us the same numbers as in the financials. We then perform substantive test of detail. We also perform substantive test of detail on high risk accounts, right? So accounts that were, qualified in the prior year, they will then get substantive test of detail. Accounts that are very prone to mistakes, for example, definitely accounts that are above materiality, they will be tested at a test of detail level. And once you've done that, you complete with the nature, you completed the nature of the planning and the nature of the audit work that's going to be carried out, right? Then from there, you go to the extent. Depending on how big the revenue is or the expenses are, extent essentially speaks to at what point are you going to stop and believe that your testing has given you sufficient evidence, sufficient and appropriate evidence for you to be able to express an opinion. So you don't need to keep auditing past the point where you know that that you're comfortable to express an opinion, right? So that speaks to extent. Maybe you look at 5 items and you're happy. Maybe you need to look at 1,000 items and you're happy. That's extent. The last one is timing. When you consider your audit planning, timing looks at when are you going to perform these activities. And the example that I often use, you know those Caterpillar yellow machines that get used on industrial sites? If you're a company that manufactures and sells those machines are manufactured over 6 months plus. So if you perform a stock count 2 months before year end, at year end, there's a high likelihood that the number would not have changed of those caterpillars that are sitting in inventory. On the opposite side, if you're auditing a grocery store and you're looking at fruits and vegetables, something like those of you guys that know avocados or bananas, if you do a stock count a day or two too late, you might find them rotten and have an unreliable number in the financials, right? So timing speaks to that ability to know when is the most relevant time to perform those procedures. And often for that, I say you need to understand and appreciate not only the client, but their products that they're dealing with, so that you're able to select the most appropriate time in order to execute some of your procedures. When all of that is said and done, you essentially would have performed the audit and your audit plan would have been executed comfortably, right? And one of the things we'd want you to know, planning continues. You can go back and at any point where if you're getting that, you're realizing that there's a risk, you can go back to the previous step, redo it, reselect samples, reselect. Maybe we don't want to rely on controls anymore, those sort of things. But essentially, that's what your audit plan would have covered. And it should be enough to take you all the way to the end of the audit. Once you've performed all of this work of having information filter through from the controls as well as from your substantive analytical procedures and your substantive test of detail, we have what we call an accumulation of misstatements. That is where you've kept a record of every time you checked something and it didn't meet the expectation that you had as the auditor. And you make a mark, make a mark, make a mark, make a mark. And then when it comes to the end of the audit, you're essentially going to aggregate all of those misstatements and then start evaluating them. Some of them are going to be below materiality. You don't throw them away, you set them aside, and then you are going to aggregate them. And perhaps when they are all aggregated, all the immaterial items, so the 100,000 here, 50,000 here, 20,000 here, maybe when they all put together, they will be material. Management then has an option to agree with the auditor and say, I do in fact see that there were no invoices for these 10 transactions. As a result, let me reduce the revenue, for example, or let me increase my expenses, for example. If that's the case, then you've got what we call adjustments that were made by management. And then that allows the misstatements to decrease because now the financials are no longer misstated. The items that you had identified have been corrected and the financials are free from material misstatement. Once that's the case, you then can express your audit opinion, which is whether the company is qualified, unqualified, or the financial statements are qualified or unqualified. Qualified means that, hey, take it with a pinch of salt. You need to qualify it. You need to actually say, hey, this is a good company, except if you don't look at revenue, or except if you don't look at debtors. That is what we call a qualified audit opinion. If it is an unqualified opinion, it essentially says it speaks for itself. So essentially say this is a good set of financial statements, and then you sit back and keep quiet. They speak for themselves. Then you have a disclaimer. A disclaimer is in essence where you say, you know what, when I tried to do my work, I didn't get enough information. As a result, I rather not give an opinion because it wouldn't be reliable. There's still more information that I wish I had received, but then management maybe didn't provide it, maybe because it wasn't here or it wasn't well stored, that sort of thing. I can't say the financial statements are free from material misstatement or they're not free from material misstatement. I just didn't have the opportunity to audit. The last opinion that you do get is an adverse opinion. Adverse opinion says we've tested everything to our satisfaction and from top to bottom, everything is just bad. If I were to say to you, go fix something, I wouldn't even know what to say you must go and fix. And in a nutshell, that is auditing in essence. What you see me having left out here at the top, introduction to auditing and the regulatory environment. That's just to highlight that always bear in mind the environment in which you are performing this work. Companies are governed by the Companies Act. Boards of directors are governed by the King Code of Governance. CAs working in the company, chartered accountants, that is in the finance function, they may be held to the SICA code of ethics or wherever you are in the world, your relevant code of ethics. So you take those into account. You must know them. You must understand them and be in a position where you're able to say, irrespective of the audit procedures I'm going to perform, when someone behaves unethically according to these standards, of the relevant legislation or regulation, I then have certain actions that I must follow or certain steps that I must follow outside of the opinion forming audit engagement. Once that is said and done, you then look at your going concern. I remember that's a question I got. How do you deal with going concern? Remember, all of this is being done under the assumption that the company is a going concern. But to make sure, management has to perform an assessment and provide you evidence that this is indeed the case. And for you as the auditor at year end, you then just verify that just to make sure that we are still under the correct system. Otherwise, you know then that the financials would have had to have been prepared on the liquidation basis. But that you would normally pick up during the audit, not at the end. While you're performing your audit work, you would actually see that gap. In fact, management would have long disclosed to you as you are coming in that, you know what, we've got a business rescue practitioner here, and he's actually the one in charge, something like that. And then that will tell you often if the financial statements are prepared on the going concern basis or not. Your job is just to say you have looked at management's assessment and you can agree that the going concern assumption is still valid. That's all I have to say. That's auditing in a nutshell. I hope you enjoy.